CME Group is launching Micro E-mini futures contracts. Discover how a smaller Micro E-mini futures contract opens the world to greater trading possibilities.
Welcome to Striking Options, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Scott Bauer. Hey there, Scott.
Jeff, how are you?
I'm doing great, and it's interesting to see what a stellar first quarter we had as the S&P 500 gained 13.6%. That historical average for the last 25 years in Q1 was only 1.7. So my question to you, Scott, is can we keep up this pace in Q2?
Wow, without having that crystal ball, we have earnings season coming up here, and I think it's going to be hard to keep it up at that pace.
Well, fair enough. We are seeing a lot of movement in the markets. We saw the Eurodollar options market, the largest open interest ever, over 37 million contracts. Are people repositioning for some type of move in Q2?
Yeah, no question. It's repositioning, and with all the Brexit uncertainty still on the table, that plays into it as well.
All right, great stuff. Let's get into this first lightning round. You ready?
Absolutely.
Equity surge. Well, it is interesting to see. We saw a 13.5% move in the S&P 500. That's a long way away from that December distress we saw in the market. How are you embracing this rally?
Well, I love the rally, but I'm really embracing it in the mini S&P 500 in a way to express, maybe a top or maybe just a little bit of an
You're
ebb.
seeing some resistance at 2,900 potentially.
I certainly am. And a way to do this would be by selling a week 2, so April 12th expiration, 2,900, 2,950 call spread. And this spread potentially allows an investor to collect about $315.
This makes a lot of sense, Scott, and it's interesting to see that June E-mini S&P 500 was trading around 2869.75 when this trade example was priced out. At the money volatility is at 1042. That volatility has really eroded, correct?
It really has, and optimally on the expiration April 12th here, anything 2,900 or under, and an investor could keep this entire premium.
Oh, it is nice to collect that premium on that expiration. Thanks, Scott. Really appreciate that. And remember, these are trade examples, not trade recommendations. Let's move into the second lightning round.
All right, let's do it.
How low can we go? Wow, a lot of people are surprised to see the long end of the curve. We talked about the inversion in the curve. We're not going to talk at all about that, but let's talk about that 10-year note. Surprisingly moved under 250, surprisingly moved under 235.
I mean, just a huge move from where we were just a few months ago, all the way down to that 235 level. Little bit of a rally back. Let's see what happens.
Well, I think that's one of the anomalies. We saw bonds surge in Q1. We saw equities surge in Q1. Where's this leadership going to come forward in Q2, Scott?
Well, again, I think we have to look towards earnings. We have to look towards what's going on with China. And at this point, I think it's a big question.
Well, that's why my trade example, I really want to look at the move in the 10-year note. The yield back up around 2.50%. I don't think that move is over with. Therefore, I want to be a buyer of a call spread. That's going to put us in a position to capture lower yields, higher prices. I'm buying the week 2 412 expiration. I'm buying that week 2 124 call and selling the same expiration 125 call. This call spread will cost about 12 ticks at the time of being priced out, or $187. Remember, Scott, this is in the event we see yields go lower and prices go higher.
Exactly. And this trade expires Friday, April 12th. And this is based off of the June 10-year futures contract trading at 123.25. And the at-the-money vol was trading down at 4.11%.
And I think when we see that at-the-money volatility decrease to that component, we're obviously seeing an inexpensive call spread. And therefore, this is counterintuitive, Scott. We are seeing a lot of folks scratching their heads saying, why do you think yields are going to go lower? Well, it's due to the fact that yields with an equity rally where it is, you would think yields would be higher, but they're not. So we have to trade the market in front of us, not to trade the market we want.
And absolutely. And, this all comes down to reward to risk. And like you said, Jeff, with volatility as low as it is, it makes these call spreads pretty inexpensive.
Great stuff, Scott. Thanks as always for coming on. And we also want to thank you for tuning in to Striking Options. Please tune in every week as we will continue to strike options.